Hi guys. Today we will analyze Eli Lilly stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Compared to the overall market, the stock is showing a nice and steady performance. Both the short-term and long-term trends are positive. Strong support levels are around $295 and $276. Next strong support levels are around $240, $220 and $180. Strong resistance level is around $320. In the last month the stock has been trading between $283 and $324 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 6% per year, for last 5 years. We see that the average profit margin of the stock has been around 16% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 102% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Eli Lilly Company: bad, average, and good. First scenario. Eli Lilly will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 6%. Future profit margin would be a low, 14%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $151. Second scenario. Eli Lilly will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 7%. Future profit margin would be average, 16%. Future free cash flow to net income rate would be average, 85%. In this case, the fair value of the stock today would be $188. Third scenario. Eli Lilly will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 18%. Future free cash flow to net income rate would be high, 90%. In this case, the fair value of the stock today would be $231. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 6.74. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Eli Lilly, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 37. Again, I will use 3 different scenarios for Eli Lilly Company: bad, average, and good. First scenario. Eli Lilly will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 6%. Future P/E would be a low, 18. In this case, the fair value of the stock today would be $87. Second scenario. Eli Lilly will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 7%. Future PE would be average, 21. In this case, the fair value of the stock today would be $110. Third scenario. Eli Lilly will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 24. In this case, the fair value of the stock today would be $137. As you can see, today the stock is overvalued, $312, even if we expect the company's high performance in future. Lilly has a great profitability rating, but there are some minor concerns on its financial health. And the stock is expected to show only a medium growth in the next 5 years. Based on that, the stock is currently too overpriced. Eli Lilly is a good company, but not an attractive investment at the moment. I may consider buying the stock when the stock drops below $150. Company strengths. Eli Lilly and Company is an American pharmaceutical company, with offices in 18 countries. Its products are sold in 125 countries. Lilly is known best for clinical depression drugs Prozac and Cymbalta, and antipsychotic medication Zyprexa, though its biggest revenue drivers are diabetes drugs Humalog and Trulicity. Lilly's notable achievements include being the first company to mass-produce the polio vaccine, and insulin. Lilly develops and manufactures therapies to treat pain, diabetes, cancer and neurodegenerative diseases. Strong pipeline with multiple potential blockbuster drugs should fuel revenue growth in the foreseeable future. Lilly is developing a new Alzheimer's drug, Donanemab, that could become a major blockbuster, especially because the FDA appears to have a lower threshold for accelerated approval for this disease. The company has developed a treatment for mild to moderate COVID-19 that has shown the ability to neutralize all known variants of concern, including Omicron. Lilly has a return on assets of 13%, return on equity of 65% and profit margin of 21%. This is amongst the best returns in the industry. Based on estimates, the earnings per share is expected to grow by 15% on average over the next 5 years. The revenue is expected to grow by 8 to 10% on average over the next 5 years. Risks. The development of new drugs from initial discovery to approval for commercial distribution may take several years, and cost hundreds of millions of dollars. Only a small percentage of drugs make it all the way from discovery to commercialization. Acquisitions may also dilute earnings and fail to generate projected synergies. In addition, patent expirations and the loss of market exclusivity typically lead to generic competition. Lilly lags in the immuno-oncology market, which may create competitive headwinds for its older cancer platform. Several of Lilly's recently launched diabetes drugs are a few years behind competitive launches and some lack differentiation, which could slow market share penetration. Lilly faces tough competition from both generics manufacturers and brand-name drug makers. Also, governments and managed care organizations continue to consolidate their purchasing power and exert pricing pressure. Lilly's shares are already trading at more than 40% above their recent historical forward average, suggesting growth potential is more than factored in. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.